Hello and good morning, everyone. Thank you for joining our webinar today, powered by the Lagos State Employment Trust Fund. My name is Omokaro Noakpo. I'm the head of blog development at the fund. And at LSETF, we're very passionate about supporting businesses and helping them to achieve their full potential. We do this in diverse ways. We offer loans, we offer grants in some cases, we offer skills, support and capacity building. But what we've also found in how we interact in interactions with MSMEs is that sometimes what they need is not even the finance, but also access to information, access to relevant information that helps them to grow and boost their business, which is why we put together series of webinars and workshops focused on topics and themes that helps businesses to develop and get the right information to grow their businesses. So we're very excited today for you to join this session, which is themed building an attractive business for funding. Our guest today is a very, very astute professional. He is a finance and investment banking professional with over 20 years of experience in financial advisory services, with deep expertise in capital markets, as well as financial advisory and project finance. He has worked with the KPMG Nigeria, worked with KPMG UAE, also with EcoBank Capital. He gained client-side transaction experience in chief finance officer roles at Transcorp, ARM, and UAC Nigeria. He's a graduate of the University of Lagos Finance and is also a fellow of the FCA and Institute of Chartered Accountants of Nigeria. His name is Mr. Ibikunle Oriola, and he'll be taking us through this session today. But before he comes on board, please, just a few ground rules. If you have any questions while the session is going on, please use the Q&A tab, which you will find on your screen. We'll definitely have a Q&A session where you can ask questions, and then we'll be able to really deep dive into whatever concerns that you have. Very importantly, this session is for you, business owners. Take really advantage of this session because people like this, you don't get them every day. They're the ones we call the big fish, right? So you don't get them every day. And once you have this opportunity, please milk it very well and take advantage of this session. So good morning, Mr. Ibikunle Oriola. How are you doing today?
Good morning, yeah. Good morning, ladies and gentlemen. It's a pleasure to be here. And I'm looking forward to a very engaging and exciting session with you all. There's a lot to catch up on and discuss, but I promise that it's going to be a session where we sort of exchange ideas and also try and share practical insights such that at the end of the day, everybody benefits from their time in this session and also can take away a number of things to their businesses or to their initiatives or projects such that they can move to the next level and also can achieve the objective of the presentation, which is the build businesses that can attract funding. So thank you. It's my pleasure to be here.
Great. Thank you for taking this time to join this session. Well, before you go into your presentation, I just want to have one very quick question. Why is it important to build an attractive business?
So it's I mean, it's a very, how would I put it now? I think it's very important because, you know, the effort you put into trying to build a business, it's not small, it's quite significant. And I think you would want to make a success of it. So at the end of the day, to measure success is perhaps the objective of building an attractive business, to make a success of it, to also sort of return back to all the effort you put in the business so that at least it's successful. And also because, again, I guess your livelihood, your finances, your future, and everything depends on the endeavor that you are on. And so making a success of it is, in some cases, in fact, in all cases, it's not negotiable. It is very important. It's mission critical. So success at the end of the day is really the reason why you want to build an attractive business. Yeah.
Awesome. Thank you very much, Mr. Kunle. So if you're ready, you can take it away.
Okay, I'll do just that. Yeah. Somebody go to help me put up the presentation. I think I shared it earlier.
Okay, yes, it should be up shortly.
Okay.
So in the meantime, please, our participants, while the presentation is ongoing, I'm sure you can see the Q&A tab is just on the middle of your screen. Just type in your questions there, and we'll ensure to take every single question that has been posted. Also, at the end of the session, you can rewatch this video, which will be posted on our YouTube channels, so that you are able to get more information regarding our services or other webinars that were posted beyond this one. So this one will be available on our YouTube channel after the session. But very importantly, pay attention, get enough information, and ask questions. So the presentation is up now. Mr. Kunle, you can go ahead.
Okay, thank you. Can you just help me fit it into the size of the screen so that we can see a page at a time?
Okay, just a moment. Let's sort that out.
While that is being sorted out, again, good morning, everybody, and thank you for the opportunity to present at this webinar. The title of the discussion is Building an Attractive Business for Funding. So basically, just to set some sort of objective from this conversation or this engagement that we're having, this audience, I believe, is addressed to small-scale businesses, nano businesses, entrepreneurs, startup companies, or founders of startup companies, or people just looking to branch out to do something for themselves, even if that's not the current activity or mission at this point. So the conversations are really addressing the needs of those businesses to raise financing or funding. And raising funding is not particularly a very easy task or set of tasks. It takes a lot of time, it takes a lot of commitment, it even takes a lot of money in itself to get to the end point that you want to. So it's also important that in getting to understand, getting to your objective, it's important to highlight what is critical to investors, what investors are looking at, what would they like to see in the business, and also highlight the things that you need to do in preparing your business to raise funding so that you can make a success of the activity. So basically, the outcome of this conversation is to talk to what investors are looking at, where to look for money, and then what to do with your business in such a way that it becomes a darling of investors and that people want to give money to your business, as it were. So that's really the background or outcome statements that I expect from this presentation. I still can't see my full screen, but I will just attempt to use.
But I can see it.
I can continue with my secondary screen. So
okay, fine. Awesome.
So basically, there are 7 points of discussions, and the 8 points, another 8 points, really more questions and answers. Basically, the first touch point is to discuss why the risk and rewards of raising money or funding your businesses other than your own resources. Then the second point is also to discuss what sources are there for a small scale business, a nano business, or an entrepreneur or a startup to raise funding. And then also in addressing those sources, also say when in the life of the business would the appropriate type of funding be relevant or needed to be used. So looking at the business cycle, just saying what to use and what are the characteristics of the business along those cycles is also a point of conversation. And then perhaps the most important slide, which is really the fundamentals of an attractive business. What are the DNA? What are the constituents? What does an attractive business need to have to raise funding? So that's really the core of the conversation. Then the other point is also discussing what is the process like, what activities are you expected to do, what are the things that are critical in terms of 1, 2, 3, 4, 5, 6, 7 items that you must do in the process of raising funds. And then because the art of your raising funds, and the art of it is really your business plan, which is really what you use to communicate what you are trying to do with your business to investors. I particularly put out this slide just to that particular conversation. And anyway, the money you are going to raise in terms of the last number seven is either debt or equity in form or in nature. And you need to be careful around what you use to fund the business at any point in time. So also just looking at what is right mix of debt and equity, when to use debt and when to use equity. It's also a conversation that I intend to go into in this session as well. And then of course we take Q&A where we both share ideas and experiences in respect of the conversation at that time. Next slide, please. So basically, you know that MTN advert that says that if you want to go fast, you can go alone, and if you want to go far, you go with a community or with people. I think that rings true for funding businesses or for financing businesses. The truth of the matter is that when you are funding your business from out of your pocket, there is how far you can go. You would always need support to get to your destination. In fact, let me just quote that Burna Boy song that says, even Dangote is still looking for money, which is true because even Dangote today still goes to the market to raise money, raise bonds, raise equity. Is a frequent player in the CP and bond market of the country today. So even Dangote is still looking for money. So it's important that you need money or you need funding to take your business to the next level, to take it beyond what your capacity can do. So basically, one of the things you have to consider in terms of raising money as a pro is the fact that it gives you access to more resources, and these resources can do specific things for you. It can help you expand the reach of your product, or even depending on the stage where you are, also help you develop or refine that product so that it's acceptable to the market. Also, if you've raised money, the good thing about good news is always that it brings good news, and the reward of hard work is more work. That's the same case with raising money. If you raise money, it improves your credibility. It puts you out there as a business that has been able to instill confidence such that people are able to, put their resources to back you. It becomes easier if you complete one round of fundraising. People see you as credible, and then you would be able to attract more as you need in the future. Then, of course, if the money that you attract will help you grow and scale your business. You at some point at different junctions of your business, there's a need for growth. You know what they say about growth, that the proof of life, the fact that you're living is that you're growing. If you're not growing, you're dying or you're dead. So it's also important that again, when you get this funding, it helps you to grow, takes you to the next level of your business. Maybe if it's a store business, you have a 10. If it's a store business, maybe you have a 10 one location store.
Okay, Mr. Kuli, I think your mic has been muted. You may want to unmute yourself.
So that was in the process of trying to move the camera. Can you see me directly now?
Awesome. Great. Thank you.
Okay. So yeah, in terms of growing and scaling, also it's important to have money coming and to be able to fund or prosecute that agenda. What are the things that people don't like about raising money, whether it's debt or equity? you owe people. Maybe debt because it's contractual that you have to pay back. Equity, the other party will take the risk of whether you pay back or not. But the expectation is that you will pay back. The only reason why anybody would give you money is that you would have to pay back. And so that obligation becomes like a burden to some people. Some people are comfortable just using their resources and using the proceeds of the business to just fund the business because they don't want to take other people's money and because they don't want to owe people. And then, of course, that becomes more critical if, for instance, unforeseen circumstances come into play. And unfortunately, the business is not able to cover its obligations. Then that risk becomes more just. So some people are motivated with that fear. And as such, we prefer to just, fund the business from what comes out of their pocket. But however, again, the limitation is that if you go by that, you will not necessarily grow to the potential of what the business can truly do. Then the other part of it is that people also are afraid of losing control of their businesses. And control can be from you just not being the absolute decision maker in the business, where it's what you say that you do, or you do as you feel, or you go in the direction that you feel, to also just ultimately just even losing the business in terms of somebody else coming to take full control of it. So depending on the arrangements in terms of the funding, people generally are also afraid of losing control of the business. And that's why you see in the course of the conversation on funding, there's a lot of contention around what percentage or stake of equity do each party hold. And then, or in some cases where, extreme cases anyway, where businesses are in extreme distress financially, they still, the owners of those businesses, you see them still fighting back or still resisting investment because they don't want to lose control. And it's a funny saying, that story around when they say 100% of zero is equals to zero. So some people still prefer to own 100% of zero than owning 10% of 100 or otherwise. But you see that it's the reality of the country or of the business landscape. In fact, there's been stories in the past where companies that went into bank failures, companies that went into liquidation or distress situations, you will find where the owners or the promoters refuse to take external funding or external equity investments because they just didn't want to lose control. And in the course of the leadership, you see that the business sort of folds up or is liquidated. And the last disadvantage also is that people also, by virtue of taking people's money, there is a pressure to perform. Don't forget, I said the first concern is you don't want to owe people money, but in addition to owing them money, you now have to deliver results. And the conversation is very direct. If you look at the case like a equity investment in a company, for the investor to put in money, you have committed or you have said to them that you will deliver a set of numbers to support the value that they are paying for the business. And so you have to deliver on those values. Otherwise, there might be consequences around ownership or around your ability to raise money in the future. So again, nobody gives you money and doesn't expect that they will get something back. I think it's very critical that as founders or promoters, is that you understand that there's a pressure for you to deliver because you have collected other people's money. The phrase is other people's money, OPM, as it were. Funny sources. So on this slide, is just us talking to where does money come from to go into small scale businesses, startups, medium enterprises, and other companies. So this list of sources are peculiar to that group of businesses, which is the audience of this presentation. So largely the first and I won't say it's the most popular, but it's the first go-to source of funding is what you call bootstrapping. And bootstrapping simply is just basically you as a promoter funding the business from your own personal resources Sometimes it includes your savings, it includes you borrowing on your personal capacity, it includes you selling your personal assets, includes you going to family and friends to be able to fund the business. So you're limiting the potentials of the business to what you can fund. And it's not unusual because again, there's a certain time in the life of the business where this might be the only and immediate option available to fund and grow the business. I'm going to talk to the life cycle and when all these things happen in the next slide. But more importantly, this is the first part. And sometimes, sadly, this might be the only part through the life of the business, especially where the promoter or owner is not open to taking external funding or financing, and is just happy to limit whatever it is to what he's able to provide in terms of the potentials of the business. The other source of funding is angel investor. An angel investor, you forget the word angel, it's not necessarily an angel, it's not a celestial being or anything. It's just human beings, just like yourself and myself, that you have access to, and they have the wherewithal to support the business, and they provide funding in exchange for ownership in the business. And this is also another widely available or popular form of funding for our type of businesses. The next one is venture capital. Venture capital largely just speaks to companies that are specifically set up for that purpose, which is to provide capital for business that are in the stage of growth. And these are businesses that not necessarily will be able to meet the requirements of banks or other providers of capital, other formal providers of capital. So this is like the first touch point with an organized company or a firm. And basically the business of these firms are to look at the opportunity that you present and then make a decision around funding for you. Then the other part is business loans. So as a small business, yes, today you can get loans. You can get debt to fund your business. Speaking specifically from three main sources mainly. There's a fourth source, but I won't put or recommend that, which is money lenders. But of course, I won't recommend anybody to go through that kind of experience, because at the end of the day, you won't find joy in that engagement. But basically, commercial banks today are able to give you loans. I think practically every bank has a small scale SME desk in their banking operations, where they have a set of team that looks after businesses that are in that SME category. But the only issue with that in terms of reality is that the definition of what is SME is quite varied, and by the time you put their definition, sometimes most of the companies that are truly SMEs might not qualify. I reckon the last time I checked, the definition of SME was something around 100 million in turnover or so. Not all businesses are in that frame, but the bottom line is that if you approach a bank today, there's an SME desk, and they look at opportunities to fund, and the opportunities to fund includes them giving you what you call a working capital loan, which is for you to fund your immediate operations, or what things that you need on a short-term basis, maybe a 6 to 12 months. This includes things like overdrafts. And this also might include things like giving you import support facility if you're a company that requires to import stuff and you need to open LCs and also some sort of support around that. Or it might also even include things like invoice discounting, or receivables financing, depending on the type of business that you do. So these opportunities exist for you to walk into these banks and have a conversation around it. The only issue is that it takes a long time, and by the time they start asking you for things around collateral and all of that, it becomes a bit more difficult and tedious to conclude. Microfinance banks too are specifically created to intermediate in this space, particularly for businesses that are necessarily not yet banked, or that don't have a significant banking footprint. The idea of microfinance banks is for them to be able to, intermediate, and intermediation comes on both sides, which is basically taking your deposit and also giving you loans. And they give a number of short-term loans. I don't think they do for. They give a number of short-term loans for businesses. The biggest issue with their loans is that it's expensive, and depending on what endeavor or activity or commerce you are trying to do, it might raise a bit of risk for you as an investor to take their loans, because again, you hear terms like they come with 20%. They come with 20% rate per annum, or they do something in the double digits monthly. So, which are things that are onerous for businesses to sustain. And the last source of loan is government concessionary loans. Basically, these are loans targeted at SMEs for specific interventions. By maybe through CBN or any of the DFIs trying to promote SME funding. And usually these loans are disbursed through commercial banks, so you still have to have a banking relationship. I think I should stress here that regardless of your business, I think it's critical that you have in the name of your business a banking relationship, even if it's not yet in the funding relationship, but it's really you just keeping a footprint and running your transactions. It is very important that you have a banking relationship. So part of your moving your business is also trying to formalize things around a banking relationship in your business. I think one of the mishaps that most business people do, especially at this stage of our businesses or endeavor, is that we, not necessarily that we're not banked, but we bank in our personal names, which is part of the conversation that we'll have in the course of this discussion, that you have to have some set of controls and principles. But it's very important again to have your business name banked today with a bank for whatever reasons. It's really part of the preparation for your next stage, as it were. And then more importantly, because it also helps you build the track record and the credit history, if you're taking credit anyway, to be able to attract funding in the future. And then again, the discipline of this is also what investors will look at around things that they're doing, and also the information and data around your business performance is truly reflected through that. I think that point is made. Let me move on. Then small business grants. For small business grant, so you usually would have a government agency or a private foundation give grants, as it were, to small businesses to fund maybe specific initiatives or specific growth objectives or targets that they have. Yours truly, LSETF, that has organized this seminar, is a provider of such grants, as it were. There are a number of names that do that, both on the government side and the private side. One of the things I would say to you is as simple as a Google search, because that's what I did this morning, just trying to give examples of the people that do these things locally, because it's not just enough to tell you them who they are, but just also to be able to name names for you. What I did, and I would recommend that you do actually for the course of you trying to search for funding, is to just type small business grants in Nigeria. You will see a list of names of people that do that. And also for all the sources of loans and incubator. But if you type incubators and accelerator, you see names of companies that do that, especially in the startup tech space. You see that as a way too. So it's good to just Google that and you find out. But just for naming, you have the LSETF, like I've said. You have the likes of Todo Elumedu Foundation. A number of these business owners have foundations of philanthropy that also supports businesses, just like Todo Elumedu Foundation. There is the African Youth Employment and Engagement Network, and YIN also that is on their website. The government-owned BOI Youth Entrepreneur Scheme. A number of those things. Just a Google search would help you. Like they say, Google is your friend. So try and just to check those, and you will find out those opportunities, as it were. The others are incubators and accelerators, which you typically find in the tech space, where a couple of entities will bring together businesses or startup companies to help them incubate their business idea or their concept. And then after that is done, they help them look for investors to take it to the seed funding stage. And then it moves to the next level as the case may be. Again, if you Google those names, you will see them. You will see them on Google. The people that do that: ARM, Co-Creation Hub, Fresh Stars, just a number of names you will see there. Also, pre-sales is also a way to fund your business, where if you have a product that is in high demand and is commercially viable, your ability to sell ahead of production would raise cash, and which you can use to fund other things as it were. Contest and competition, I'm sure you guys have watched them, Shark Tank, and the local one too in Nigeria, where people come to pitch their ideas. And then if examples also is in the culinary or cooking space, where there are competitions for chefs to win significant sums of money, which is enough for them to start or do something with their businesses as well. So that's also an opportunity for that. Next slide. So this slide speaks to what kind of funds you can raise. I mean, going back to the sources and at what stage of the life of your business you can do this as well. And then what are the characteristics of those businesses, and who are those type of people that would be interested in it. So basically, speaking to the audience again, that we're looking at SMEs, nano companies, startups, entrepreneurs, and business promoters. I feel that conversation is relevant along the first three spectrum that I've identified, which is from the startup, traction, and growth phase. A lot of the activities that will happen in your business at this point is going to happen along those three states, and I would explain what I mean about those three states anyway. And then, of course, when you are finally arrived, like they say, your own done better would be more of the maturity stage, and which is where most businesses want to get to, which is the answer to Mr. Makaro's question and say, why is it important that you have a successful business? It's for you to get to that point where your business is matured and everybody wants to give you money. And I mean, you open your doors and there's money. And the reason why that is because a number of things have happened over the life of the business at that point. So for a startup, and so another thing around what kind of funding you can use at this stage, there's usually an overlap too. It's not a one size fits all that, okay, if you're a startup, you would only be able to do bootstrapping. Yes, true to some extent, but they usually overlap too that, okay, if your resources are significant enough, you can also still go bootstrap from your startup stage to your traction stage. And then also between your traction and your growth, there's also an overlap, because what really defines the traction and growth is really that there's some measure of success that is already happening. And so you can overlap funding as well. And then the last part, whether you're matured as well, you can actually, from even your traction stage, be able to attract debts, mezzanine, or even equity, as the case may be. But so that I understand that as you move along the life cycle, your funding also overlaps. It's not stationary to one side. Yeah, when the reality will be that you raise most of what you need in one part of the spectrum, but again, you can straddle the different types of funding. So I'd explained bootstrapping earlier. Seed funding is really just money that you need basically to move your business from concept or from its initial stages to a point where you can prove that it's commercially viable, or where you say you get traction. Traction basically literally means that there is positive movement. Do you get me? And that positive movement speaks to you demonstrating the viability of your product or what you're trying to sell, or your underlying service, where there are more demand for it. It's obvious that there's a market. You've identified that market, and that market is growing. Growth is where you've reached the point where you've gone beyond you just being able to demonstrate that there is growth, that there is growing, but you've now established markets, you have customers, you have a channel, you have dedicated channels, there's a market fit, you even have a brand per se, and then your selling point as a brand, people like it, and people identify with it, and at that point, you're at a point where you can actually attract capital. I mean, that's really where you want to be. That's the sweet spot of of this conversation from an SME point of view. And the maturity is because you're now a big boy, let me use that word, and you have significant market presence, you're spending large, you're doing big projects, there's economies of scale, and then there's efficiency of cost too as well. So that's really the characteristics of those business stages from the business and product point of view. So bootstrapping would be relevant in startup because, again, that's the point where you have not yet proven what you want to do. A lot of people are not rushing to give you money just on the strength of your ideas. You have to develop and refine it to a certain extent. You have to show proof of concept or what you call market viable product to the market so that people can now come in. Once you begin to make success out of that and your business model is clear, your product is launched and people are buying, but maybe at this point your distribution is not widespread, it's still limited. But yeah, there's a market, but because your resources, your bootstrapped resources or bootstrapping resources can only take you to a certain point. So for instance, maybe you are limited to a certain geography, and there's opportunity, you feel that the type of customers or the market that you have in that particular geography, there are people that are also similar in other markets, would definitely take this product that you're working on. You need some funding, then you now need to go and get seed funding. So seed funding will critically come from your angel investors, your venture capitalists, and crowdfunding, and all of the other things that I mentioned. You get to that point and you need money from those kind of people to help you push and develop that idea beyond what it is as a concept to a proven market product. So again, that's where you look at seed funding as well. Then the series funding, or what you call round of funding, is again, you have this product has gone a few steps forward and is entered into the growth phase. It's something that can work or is already working. Then you need to move towards more formal providers of capital. So that's when we're talking about angel investors, PE firms, hedge funds, as it were. Again, don't forget that I said that there's no one size fits all in terms of the timing or who provides money, because again, all of these things can straddle along different spectrums, as it were. So your series A, B, and C, or your round of financing, is basically saying you will get investors at different junctions to come, which are these guys that I've mentioned, to invest in the business. And the what determines whether it's A, B, C, or D depends on the frequency or the timing that you need to move different steps, do you get me, in the life of the business. So maybe perhaps you've identified that, okay, you want to do geographic expansion to the southwest of the country. You can call it a round of financing. That I believe that's your Series A. You've now gone beyond that. You feel you want to support it, you want to backward integrate your production with your sales, and you need to acquire a factory or something, rather than you outsource it outside and you need a round of financing. You can call another series at that point. So at the different junctions, what you call in terms of what you require, what you call your Series A, B, C, and they can be from Series A to Series X, as it were, leading up to the point where you can go to the market yourself based on the stature of the company to raise capital. And basically what will happen driving the IPO or the debt or the mezzanine phase is also that, because these guys that have invested all the while would want to get out of the business and want to also move on to next things, or just realize the value that they've accrued over time by supporting you from your traction stage to your growth stage. They want to capitalize on that, so they need an IPO. They need what you call an exit for them to leave the business and maximize value. So that's why you have all these other issues around IPO. And then, of course, depending on what your characteristics or fundamentals are, you can raise debt right from your growth phase to your maturity phase, because from growth phase, there's a bit of recognition around what you're able to do and what you represent as a company. You have credentials, you have things to back up where you're coming from, as it were. So you can also raise debt along those lines. Mezzanine is it's an instrument that starts as like a debt and then can be converted to an equity. So basically, it's also that, again, all these guys, the venture capitalists, the PE funds, the public, not necessarily the public, sorry, the PE funds and the venture capitalists would want to take a guaranteed approach in terms of how they fund the business, so that they know that you pay them, you are able to pay them back. But however, if there's an upside, they convert that debt to equity and participate in the upside of your valuation, as it were, based on the targets that you have discussed. All of these happen when the business is matured and you have taken the business to the final bus stop for where you want to be. In terms of your team too, you would find out when we talk about the real fundamentals of an attractive business that the team is very important. And then more importantly, because you can't do it alone, so the size of your workforce to also reflects as you move on, and the kind of financing too that you will raise, as it were. So, you know, from a startup point of view, you start very slow with 2 people maybe or more, depending. Maybe at this point you're working with families and friends and associates also working to support you, or advisors. Then that moves gradually to maybe over 10 or more. There's no hard and fast rule in terms of numbers. These are just indicative numbers to show what a typical size of those business could look like. And then when you get to go maybe at 20 or more, and then of course by the time you are reaching your maturity, you've actually built a colossus or more or less. So you probably have employees over 50 or over 100, as the case may be, as it were. Next slide. So this is really the meat of the presentation. What is the business? What does a business that is attractive? What do they have to be able to attract funding? What are they? How are they supposed to be set up? What are the things that are important? What are the ingredients that make this soup of being able to attract funding, make it sweet, or literally just be able to be the toast or darlings of investors? So I put a set of things that I feel are critical. There might be more things, but I just feel like fundamentally these are the things that you need to have as a business. And the interesting thing is that, you know, yes, we've said that the audience is an SME, startup, entrepreneurial and audience. But the truth of the matter is that is these same ingredients that, or these same fundamentals that even the Fortune 500 companies need to have or already have, that puts them in that position. That's what a Dangote Industries Limited has. That's what the UBA has today and needs to have. So whether you're small or you're big does not excuse these fundamentals. Your business must have this right from now up until then. The only difference is the elements of it that you should have might vary or evolve over time. Of course, because again, largely because of resources and also because of how you are set up at the point. But all these elements must be present today. And also as you grow to where you want to get to from a maturity point of view, or from a mature business point of view, would also be needed to be present at that point in time as well. Then beyond that as well, it's also very right and apt to have that conversation around these elements of fundamentals now, because it's also good to build from the beginning. If you remember that Stephen Covey rule or principle that says you should begin with the end in mind. This is where you want to get to. So it's also very important that you start to structure your business to tick off these marks, as it were, from now. And then, of course, again, these things are just fundamental to a business, whether it's a big business or a small business. If you don't have it, you are likely going to struggle, either at the immediate or in the future. So it's also very good that you are deliberate and intentional about all of these things being present in your business, as it were, from now. Okay, so the first one is effective processes and controls. So every business must have a set of policies or process or activities that sort of reinforces control. And it's very important because if you don't have controls in your business, you probably are putting the business in a lot of risk. This is really what you call risk management. And like they say, even as individuals in our personal capacity, we're faced with risk in the everyday chapter of life. Talk less of a business. So your ability to institute or implement a system of control is very important to the risk management. In fact, it's at the heart of your risk management of your business. And it starts with things around you properly taking the discipline. And I repeat the word discipline because again, we make a lot of excuses for ourselves as small businesses that I don't have the resources to employ an accountant, or I don't have the resources to do this, or this will require investment. The money I'll rather put in the business itself than do these things that are necessarily not core to business. It's not really me selling anything. It's not really me getting new customers. It's just me trying to protect the business. The discipline is very important, and the basic discipline is really to record, keep records of what you are doing. If you keep the right records, it gives you information on what you have done. So for things like what you have spent money on, you have a record of what you have spent money on, and so when you are beginning to compare your spending or your expenses, you're able to have a track around that. Your revenue, what you are making, keep record of it too as well. Because again, at the end of the day, when you are talking to investors, the strength of your business to them is that you're able to sell as much as X, and that X needs to be verified or reported. So that's also important. The money is also very important. You need to keep record because again, you need to monitor your cash. At this point in your business, cash is perhaps the most important and the scarcest resources that you have. So all these things are also very important. And then also in terms of you making decision is on the strength of the record and evidence of information that you have put together that puts these issues into context, as it were. And then also you have to comply with your regulatory obligations. I think the chief of them is really your taxes, for instance. Because again, if you're a business that doesn't pay tax, that conversation will come up when you want to raise money in the future around what is your tax compliance history. Do you get me? And don't forget that the memory of the tax man is 6 years. Within 6 years, even within a year or within 2 years, your business can move from one of those stages that we mentioned to the next stage. And then it becomes for you to show your track record of compliance that it becomes a problem. And if you don't keep proper records, you don't know what to file. And if you don't file properly, you don't pay your correct taxes or you don't even pay at all. So your compliance regulatory is also dependent on these systems of control. And the question will be, okay, yeah, I've told you what you need to, what is expected or why this is important. And the question is, okay, how am I able to do it as a small business? I not necessarily don't have money to employ an accountant. I don't necessarily have money to implement a system of ERP, or I don't have this, I don't have that. I think the most important thing is the discipline part that is the first and the most important thing, which is really you thinking to yourself, what am I doing? Am I even keeping a proper record? So as you dedicating, as simple as dedicating time to even document what your sales are in Excel sheet, do you get me? That discipline will translate to when you have resources that you're able to get an ERP. Then of course, again, you might not necessarily employ an accountant today. You can also outsource some of this work where maybe at the end of every 6 months or at the end of 3 months or at the end of every month, ideally it should be at the end of every month. Do you get me? You bring in an accountant from outside on an outsourced basis. It's not as expensive as you would think, but you need to recognize that it's an important element of your costs too that you have to address. Do you get me? You bring an accountant in on an outsourced basis to help you prepare your accounts, help you do your filings. I know these things, just as they are small scale businesses, there are advisors and accountants and people that also work for small scale business. In fact, the whole bread and butter is to target businesses like yourselves, and they're able to address that. And it's just as simple as you asking around within your network of family and friends. You will have access to these people. They're not necessarily expensive, but they will help you do what you need to do. And then it also still starts from you keeping proper records, as it were. Next thing is your strategy. Strategy, they say, is the heart of every business. Strategy defines why, what, how, when all the questions around what you are doing is answered by strategy. And you being able to have a robust strategy is very important. It's not necessarily that, okay, you have to be strategic in your direction or actions when you're already, when you postpone that conversation to when you're a matured company. The truth of the matter is that you never get to a matured company if you don't have that conversation right from where you are. What are you doing? What is your business? What are you selling? Who are your customers? Who am I targeting? Do you get me? What are my broad targets? What's my mission? What's my objective? And this is not a textbook conversation, it's a real life conversation, because it's really what informs your activity. It's really what informs why you need to get out of bed in the morning to go do what you do. And so you need to articulate it. The thing about strategy is that you need to write it down. You need to articulate what you are doing and why you are doing it and how do you want to do it. In terms of saying how do you want to do it, there will be specific actions that you need to take. You need to record those actions down. You need to measure them. Set KPIs that says, okay, what will be measure of success around these things? Do you hear me? How will I be able to say I'm successful? What timelines am I looking at? I think it's very important that you bed that down, because again, when you engage with investors, is your understanding, articulation of those strategies that gives them the comfort to say that this person knows what he's doing, or is very clear around the direction that he needs to go, and that convinces them or gives that necessary confidence to them to put down money in your business. So it's very important. And also one thing about it is that strategy is an active and adaptive thing. Where there are changes in the business, again, you look at that strategy, you revise it, and you move forward, because your ability to be resilient as a business owner is also very important, because things will come your way, headwinds will come your way in the course of your execution that will throw some of the things that you are planning to do out of the table. But again, your ability to respond to those things, adapt your strategy is also very important. The other issue is the financial health of the business. Yes, you are a business that is going through phases. Yes, you are. You don't have all the monies you need at this point. But at any point in time, when an investor is looking into a business, either a Fortune 500 company or Ibikunle and Sons, it needs to see that the business has strong financial antecedents. And the first thing is that every business must generate cash. Yes, it is very important. The more the cash that you can show that your business generates, the better or the more attractive you are for funding. Yes, I can understand that you are at a seed stage or a startup stage where you still have to put money in the concept. But outside of that stage, once you've gone out, your ability to realize your cash is very important. So you have conversations around how much do you sell and how much cash do you really collect at the end of the day. And of course, when do you collect that cash is also very important. And then lastly, of course, what are you using that cash for? So that's why, again, things around, when people take withdrawals as promoters or sponsors from the business, it must be done in a structured way. You must pay yourself salaries. If you take money from the business, it must be reported as a loan. If you put money in the business, it must be reported as you investing in the business. So all of those things are important as well. And they speak to the things I've said around the processes and controls as well. Just you giving yourself and subjecting yourself to the discipline that there's somebody else that will be watching this at some point in the future, even if there's nobody else in the business beyond you. Then the other thing around the financial is that you must show that you are growing. There are metrics that are critical to the business that you are doing. There are KPIs that are important. Those KPIs over the years should be seen to be growing. So if you're in a traction stage, you must have KPIs that speak to maybe things around your sales growth, your profitability, your margins. Margins being that how much profit are you able to make from one naira of sale? Your profitability, how is it evolving over the years? Do you get me? All those things must speak to a strong growth trajectory, and it can only be so because you got your number two right, your strategy, and you're adapting that strategy to things that are important to make the business grow. You must be funded at all times. Do you get me? At least at the point that you are in the business. Yeah. So at any point in time, if it's one area of your personal money, do you get me? You must have assets that tie to the one area, but not a situation where you have 1 area of your business and 10 area of debt. Do you get me? Then it becomes a problem. That funding is not balanced. Your funding should be balanced, because again, what it means is that whatever that business represents today is owned by the people that have given you those debts. Do you get me? So that's the problem. Strong working capital means that you're able to fund your business. That's what you call spontaneous financing in business, where the business is able to fund its immediate requirements spontaneously, without not, looking for third-party source of credit. Do you get me? Or going through a process to raise credit or raise money to fund those immediate working capital needs. So again, things like you having access to a standby financing, like having a line with the bank, and all of those things are also very important. And then for every level of debt that you have, you must have the capacity to pay. Capacity to pay the principal and the interest, and then the capacity of the business from a forward-looking point of view, meaning projections beyond year 1, year 2, year 3, or year X, that is able to pay those debts or obligations that you carry, as long as those obligations exist, as it were. The next issue is corporate governance. I know the first initial reaction would be to say that, oh, why do we need why do small businesses need corporate governance? What concerns Abu and spaghetti? But the truth of the matter is that if you look at the history of startups abroad and locally, they are susceptible to failures due to failure of corporate governance, just like any of the big businesses are also as well. The recent ones, startups like FTX, is popular in the news around the Bitcoin thing, where they have issues recently because of failures of corporate governance. And then also, even in Nigeria, all these fintech companies are in the news at different times for negative news because of failure of corporate governance. So speaking to it, the heart of corporate governance is really, 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 really important, because again, it addresses the issue of why and what you should not do as a promoter or as a one-man business. Do you get me? Because again, what corporate governance does is to govern your relationship with other stakeholders in the business, starting from the public, your employees, do you get me? Your customers, and then your partners too as well. So your behavior to say, I can be all and do all, it is my thing. Do you get me? Corporate governance is really what is needed to address those issues. And you agree with me that, of course, the only point where you can be at risk is when you are only the only person, or you are the dominant person in the business. So you need it more as an SME or as a startup or as an entrepreneur than even, or as, let me not say than the big companies, but as much as the big companies. And what you require for corporate governance basically is just to have a system where, you have somebody that gives oversight, somebody that holds the business accountable, or a group of people, which in this case is a board. But again, I understand that you might not be able to start immediately from a single sole ownership business to being a company that has a board. Even the life cycle that I looked at in the previous slide also speaks to the fact that maybe perhaps you only begin to have a board when you are in the maturity and growth phase, as it were. But more importantly, I think the set of the principles around you being accountable, around you not doing it alone, around you finding partners, finding advisors, is also very important. Do you get me? Because the track record that you set from there is also what is important. And the way you can also model your business is this. There are codes today that speaks to proper corporate governance. I don't think it's too much work or is overdue if you take those codes, read it, and just generally get familiar with the behaviors that are expected and the structures that are expected. I believe when you look at those things and get an understanding of it, you might find a way to adapt them to your business, because at the end of the day, what you want it to look like when it gets to the point of maturity, we are designing it and looking at doing it from now. The next issue is people. You need people. Investors would like to know that there is a set of people that are energized, understand, and have the experience to do what you are planning to do with the business before they give you money. In fact, there's a cynicism that says that if you can't find people to come work with you, do you get me? Are they comfortable to give you money to push or drive the business? So it's very important that you have people, and the people starts from you. I think your resume is the biggest thing that sells the business as a promoter. You need to show that you understand what you're saying. You need to show that you have experience. You need to show that you have capacity as well. That in all of these things that you're trying to do, it's there. And they will look at your resume. They will look at the resume of your core team or your key partners as well to be able to come to a point of comfort around what they are doing. And of course, your ability to attract talent too as well. Again, I know it's a small business. You can't have a management team from day one. Do you get me? But even things around, building some sort of confidence around the one person or the two people that work with you immediately and getting them motivated and giving them direction and creating a culture. Do you get me? Even from your one-man shop or your two-man shop or your three-man shop to where you go is also very important and things that you have to be deliberate about today. The last issue is, how do you communicate and engage with your stakeholders? In the big companies, you call this investor relations, but for all businesses, whether it's small scale or just a promoter-led business, you need to be very deliberate around how you communicate and engage with your stakeholders, investors, customers, staff alike. One of the things that communication would help with your investors or with your stakeholders is it helps you to be more accountable and you get feedback. And then from that conversation, you're able to show or demonstrate to those guys, to their confidence that, they're in the right place or invested with the right partner, as it were. So it's very important that that communication happens. I know the issue is also that people always deliberate, do I overshare information about my business or do I undershare information about my business? I think you just need to get the right balance, and then you have to be deliberate around when to communicate. So if you have partners and investors in your business today, you should be thinking to communicate with them on a regular basis. That's why, again, going back to established firms or matured firms that are perhaps listed, that's why you see they have annual reports, they have quarterly reports. So in your own business, you need to adapt, or even monthly reporting, that what time do I need to speak to people? And that time, once you have decided to communicate your business to them, it has to be consistent and you have to follow. It can't be that you're comfortable doing it in this period and you're no longer comfortable doing that. And the information you're giving them, it needs to be concise. You are reporting about your business, your P&L, your performance metrics. The set of information you report from month to month should not necessarily change. It should be direct. And if you need to report any extras, maybe if there's an unusual good news or an unusual bad news, then you add it to the report. Or if the stakeholders at the beginning, you also put that forward in the regular thing. Then typically people like to hear bad news as soon as it happens. You don't want to sit on it and then the consequences come through, and that's when you're revealing information to your partners or to your stakeholders. So if you think this person needs to know and is relevant, it's also good to share it as it happens. And the truth of the matter is that sometimes that also helps because you don't know who is able to address your problems amongst your stakeholders. They'll give you a perspective that would help address or resolve those issues. Then paint a complete picture, be as honest as possible. Don't take an optimistic view of a bad news or a bad consequence. Let people know what it is. Let them know what they call the cocoa of the gist so that they are able to also react or address it as it were. Don't use your time thinking what would they do or how would they do. So to use that to manage the information. Present the information. If it's the right stakeholder, present the right information to the right stakeholder. Next slide. So this slide speaks to, I will try and move very quickly because I believe we've spoken for a while. This slide speaks to the activities involved and the mindset and the preparation you need to have when you go out to raise funds. So the first thing is do your homework. Your homework starts with yourself. How much do you want to raise? Have a sense of that. Do you get me? What are you going to use the money for? How long do you think it will take to raise the money? In the case of where it's an equity type of money you're trying to raise, how much control do you want to give? How much stake do you want to give? Do you get me? Who should you go to? Do you get me? Who is able to offer this? So that at the end of the day, you are prepared before you go out. You know who you will target, you will know how long it will take, and you are preparing yourself for success out of the exercise. Just taking some preparatory work up front. Then the other thing is, you need to have a clear understanding of your market opportunity as well as your competitive landscape. Because you're selling a product, you're the target market. Investors want to be sure that that target market exists, is viable, and is actionable. Do you get me? That you're able to convert your ideas to sales with a particular target market. They want to know why, what are you offering them? What is your unique proposition to this target market? Why, what is your product or services doing or addressing? What pain points is it helping them to resolve? What will make it an attractive proposition to those people? Because they need to know that you're able to sell the underlying thing you are doing or your underlying endeavor. So that is also very important. And also your competition in the landscape too. You need to be able to understand that too. Who else is providing this? Who is providing substitutes? The things that I'm providing, can somebody come in tomorrow easily? If they like what I do, can they copy it easily and start reproducing and put me at risk? All of those things need to be firmed up. Once you firmed all of those things up around your market and all of that, then you also need to create a detailed business plan. Your business plan, I will call it business plan and or your pitch, because again, everything you're pitching to your investor is coming out of this business plan. And the business plan is very important because it basically puts your understanding of how you intend to, use the money that you are raising, how you intend to utilize it, what you're going to use it for, addressing things like your market, how you're going to organize yourself, when are you going to fund, what returns are you expecting from this, as it were. So that's very important. The next other activity that you need to also be cognizant of is you must know your number at heart. Nothing instills confidence to an investor speaking to a promoter that is on top of his numbers. Numbers around, you know how much you are making, you know how much you are spending, you know how much your what you call your burn rate. So you have ₦1 today, you know how long it will last you. Do you hear me? You know what you want to use the money that you are raising for. You know what your projections are. So they ask you year one, how much do you think you will make? You're able to say. Year two, how much do you think you will make? You're able to say. So your confidence, how comfortable you are around those numbers are very, very important, and it's like perhaps the first or one of the major things that reinforces confidence in investors around what you're trying to do. Then build a strong team. I spoke to people in the last slide. Again, that is very important. It's not about you, it's about the people that you are going to work with, because one person cannot necessarily execute on his own. So your ability to attract correct people, the kind of environment or culture you have built, all of those things are important as well. And people like to see that you have a team in place at the point that you're trying to raise funds, that you have the people that will execute the goals you're trying to do. The other thing is that you need to prepare for due diligence. So everything you've said from 1 to 5, the guys that are investing would want to get a sense of how true it is. So they're going to test, interrogate. They're going to ask you for information. You need to prepare information. That's why the things around your controls and processes that I mentioned earlier is important. Do you get me? You need to have information, your accounts ready, your audited numbers, your sales figures, your sales forecast, your customers list, as is relevant. Do you get me? It's also very important. So you need to be prepared for this. And to do this, sometimes you might need to work with advisors. Again, I mentioned the fact that as there are small scale businesses, there are advisors that work with small scale businesses too, as well, to get these things ready. And then the last thing is that you have to have realistic expectations. That comes from one, how long do you think the process will be? It might take a while longer than you expect. Two, it might take a while longer than what you want. Yeah, the kind of money you want, you might not necessarily get. So you need to have a plan B. Do you get me, around what your funding is? Now you want to fund the business. And then also, because again, you might also have realistic expectations around your valuation. Do you get me? You might think your business is worth 100, but by the time you've gone through due diligence and valuation, you might be told that your business is worth 30. And that brings you down to earth, as it were. So you also have to have realistic expectations around that. And that, again, in the case that happens too as well, what will be your responses? How would you respond and drive or move forward with that? Next slide. So this slide speaks to the details of having a detailed business plan. What are the elements that you should put in it? I am going to run through it, but I believe this is one where, again, even if you've read this, do you get me? There are enough materials online on what a good business plan should look like. Just Google it, do you get me? And those materials are simple enough in terms of providing guidance to you on how you want to do it. Then even there are business plan toolkits as well. Business plan toolkits as well that you can pick up on the net, and then they will, basically when I say toolkit, it's just basically almost a prepared document that all you need to do is adapt it to your situation or what you're trying to do, and then you're able to come up with something detailed. So they ask you the right questions, and by the time you're answering it yourself, you pretty much have a business plan as well. Then of course use professionals. Do you get me? Because there's an element of your business plan where when I said knowing your market and all of that, you might need to actually commission a research, depending on your resources, to validate your assumptions around your market, the size of your market, and the demand gap or the supply gap. The supply gap, because you have a demand gap, there's a problem already. But if you have a supply gap where there is more demand but there is less supply, quantifying that, what does that mean in naira and kobo? All of those things might require you also getting somebody to work with you in that respect. But the matter of a business plan, you must have an executive summary, which basically often captures the key message that you're trying to sell. Basically, you articulating what your business is all about, what your mission and objective is, and what the end game will look like for you. The business of what you're trying to do is executed the way you want it. Then the second part again is your management and organizational description. This speaks to all the things I've said around your talent and your team. Basically, you are outlining who is going to do what are their qualifications, what gives assurances to investors around the fact that they're capable and well-resourced individuals to drive or address the strategy that we have articulated. The other issue is the competitive analysis, which still speaks to who and who are in your space. How are you going to differentiate what you are selling? Do you get me? What are your threats of competition or threats of substitutes? Again, just you articulating and reinforcing that message that the product or service is in a good place and it's not subject to threat of competition, as it were. Then also describing the products and services, what you're going to be selling, the company itself, what is its legal structure. Again, maybe I didn't mention, because maybe perhaps I thought it was mundane. Your company needs to be registered. It speaks to the conversation around corporate governance. That's also one of the starting points. You must have a registered company, suffice to say. So again, what is the legal structure of that? Who are the shareholders and at the date? Do you get me? What are you selling? What's really the business or the company all about? Then your market analysis is also very critical, because again, this is where you're saying this is the market, and this is why I said you need to get a market. You might need to get a market research person, as the case may be. But if you know your market, you know your data, you know your information, to be able to articulate the existence of a market, the existence of people that are going to buy what you're trying to sell. Do you get me? And demonstrate that they're not only that they exist in such a significant number that they support the viability of your business going forward, so that you're able to meet your targets. And then also, of course, how do you plan to reach those markets? How do you want to acquire a customer? So you detail your strategies along those lines as well. Then the last part is your financial plan, which basically is your framework for your revenue generation, your cost, your forecast. How much do you need? Do you get me? How will the company be funded over the life of the proposals that you're looking at? And then how will the business be structured? How's the organization? Who is going to execute the strategies? What strategies are you going to employ to achieve different objectives? And then what actions follow those strategy? What organizational structure you're going to use to support that as well. All of those things also are important in your financial plan and operating plan. What I want to say about business plan also is that you need to make it as concise. It doesn't have to be all over the place. Have what you feel is important to these investors. Do you get me? And basically have that in mind. Once you have that in mind, communicate towards that objective or what you think is important, as it were. So that conciseness is very important. And then address all the blocks of why, how, when, and what. Basically, once you answer those things, you pretty much are on your way. And your business plan is also basically your pitch. It's maybe perhaps a more streamlined version of your business plan that you're going to pitch to your investors. So it's important to get it right from here. Either present the business plan itself as a pitch or reduce the contents and make it more focused in direction as a pitch. Maybe perhaps you've already had engagements before that speaks to what they want, so that you cannot dedicate or tailor your pitch to those particular requirements. But basically, the heart of it is really your business plan, and that's what they are moving over to pitch investors, as it were. Next slide. But again, let me repeat the fact that it's not rocket science. There is abundance of materials in terms of structure and look and all of that for you to leverage on offline, online. A Google search will take you to some of those things that are available. But I think what is experience in that field, such that you're able to articulate those things in a way that is clear, that somebody taking the stock of it will know that you know what you're talking about, and you're able to address those things. The last two slides are really around whether you want to use debt or equity, maybe what are the things you just generally need to be mindful of, because to be honest today, debt you do really have access to debt. Maybe it's from a bank or a microfinance bank, or even from family and friends, as it were. You just need to be mindful of a couple of things in terms of things to consider. So the first thing is, don't take debt because of your current situation or your choice of whether you want to use equity or debt. Let it not be involved because of that is the money that is available now, and I'll just take it. Take a 3-year view. If you want to extend it, a 5-year view. And the reason why that is important is because every money comes with certain obligations. Do you get me? So you might, in the case of a debt, for instance, you might take money that requires you to, for instance, say, tie in as security one of your revenue sources today. Do you get me? But at the end of the day, maybe the revenue sources has potentials to grow beyond the amount that you have tied in. And as such, when you need to fund, do you get me, the capacity to use that revenue source again, you can't, because you already tied it to one thing. Or it could be an asset that you have pledged as collateral. Do you get me? Where in terms of valuation, that asset might be more or will be bigger, and you need more debt or in the future, and you're able to do it. And then of course, debt will tell you things like, oh, you can't take in, if somebody's giving you a substantial part of your money funding as debt, say the bank will say, oh, you can't even bring in new shareholders. Do you get me? What you call a change of control in reality, without without their approval or consent. Do you get me? It could also be that again. It could also be again that the money you are taking. Do you get me? Is within the context of this year. If you take it this year, you won't have enough for next one. To come and be taking money every 1 year. You need to take a 3-year view and maybe establish a line or something. So those things you need to take a view. Or if you take what you need, you get me, it's obvious that you have too much debt in the business. And maybe perhaps it's not even an option for you to take that. Maybe you need to concentrate on you raising equity, as it were. So take more than a year's view. Don't be short-sighted in terms of your planning or rising. I think it's very important. The strength of your company's business relationships too are very important because again, it's in that network that you have built that you'll be able to get access to more investors, maybe on the equity side. Do you get me? You'll be able to get more businesses to itself where you are able to fund the business from your own internal working capital relationships, or even get favorable terms of trades that will help you or relieve you of cash flow needs or funding needs, as it were, too, in the course of your operation. Then, like I said, cash is king. You can't overemphasize that. Your ability to generate cash from your business is important. So there's no point saying you've sold, do you get me? And you are selling, your sales is good, but at the same time, your receivables are high. Because again, you still need to fund your business. And that means you have to borrow or go and look for capital to fund. And even in the course of that, you might even make some losses around your collections where you're not even able to collect in full. So you must be able to generate cash from your sales. Look for terms of trades that, on a priority basis gives you cash as early as possible, so that you are not struggling from any stress because you are not liquid at that point. So that's also very important. The stage in the company's life cycle is also important. We had spoken to the different stages in the life cycle. Do you get me? So at the early stage, be careful not to take a lot of debt. Do you get me? Until you get more, until you approach maturity. Just these are rule of thumbs. They're not necessarily true in all circumstances. So let me put that out there. But you just need to be careful to take more debt at the early stage. When you have significant asset base, you can leverage those assets, as it were. Do you get me? Also, again, you are also careful as you dilute yourself along the life cycle of the company in terms of the equity you are raising, so that again you are still in a position where you're able to control the company. That also is very important. The secondary value of your fixed assets are important. The higher the secondary value of it, the more adaptable you are to take debt, because you can use it as collateral and you can take more in number, and then you don't necessarily have to put your control of the business at risk, as it were. Your proportion of fixed to variable cost is also very important. This speaks to the heart of the business, the economics of the business itself. Because the truth of the matter is that if you have a lot of fixed costs, for you to be profitable, you have to recover or cover those fixed costs. And the problem with fixed costs is you are going to keep incurring them whether you are making money or not, whether you are making sales or not. So you have to make such enough sales to cover first your variable cost, and then once you finish, cover your fixed cost, because you're still going to incur those ones. And if you have that kind of situation, you can't borrow, because the debt in itself is also fixed. Do you get me? The interest you're going to pay is fixed. It doesn't have anything to do with your sales, as it were. So you don't want to have a high fixed cost in your cost structure and then add another additional fixed cost element, which is interest. That's like double wahala for dead body, like they say, or like Fela said. Then lastly, the purpose of what you are raising the money for is also important. So if it's a short-term thing, yeah, you can quickly raise debt. Do you get me? But if you want to fund or develop a project, and considering maybe you have enough debt in the business, or the business might be very risky at the initial stage of its life in terms of the chances of it converting to cash flows, you might decide to use equity. So the purpose is also will determine what you need to do. Next slide. Continue for debt. This is just a number of conclusions around what you should still also consider, but they're mostly centered around debt. I think some of them are actually very obvious as we go through them. It's very difficult to raise debt when there's no track record. I don't think I have to elaborate more on that, because I know even as we speak in the audience, there are people that have tried to raise debt from the bank, and on the account of their track record, they've been turned down or didn't get the outcomes that they want. So I think I'll leave that. Then do not fund your long-term needs with short-term borrowings. The consequences of you doing that is that those short-term borrowings will crystallize. Do you get me? The cash that you expect from your long-term needs or you're anticipating will not have come in, and then you have a gap. You have a gap in the interim, and that gap has led to many companies failing or closing before their time. If you have working assets requirements, use things that don't cost you to fund. And basically, what I mean by that is look at your internal sources. Do you get me? So one, I mentioned pre-sales. If your product is a product where you can collect in advance, people pay in advance of production, good for you. Try and leverage that. Do you get me? Where it's not where you can collect in advance, if you can use suppliers' credits, do you get me? It will also be very useful. So if somebody comes to supply you raw material, you tell them you pay in 30 days or in 45 days, because ideally you expect before that 40 days or 30 days, the products that you will have sold them and you have collected cash. So those are the things around that particular line. Don't give lenders reason to doubt. Try as much as possible not to default. Because once you default at one time, it puts them on inquiry. Yes, maybe you default at once, banks might hear your story or lenders might hear your story. But if you default a second time, it becomes issues around them triggering remedial actions. And one of the things that are also very important that you don't want yourself to do now is that, we have a credit bureau now where everybody's credit record is put in a centralized database now. And just like as it is with advanced economies, you can't raise for that credit without that being checked. Do you get me? And then you don't even want to have that history, because when you are beginning to talk to serious investors, you don't want that to be what will hold you back in that conversation, as it were. Then, if you have debt, you have to prioritize your debt providers. Do you get me? this is more so not because you're going to give your investors dividend ahead of your debt. It's more because of yourself. One of the biggest problems that people have mentioned with entrepreneurs is the issue of lifestyle. Do you get me? Prioritize the business, prioritize your lenders first before you spend on that lifestyle item that you want. Do you get me? I think it's very important. I think it's not even that you are paying your other shareholders. It's really more because, again, the discipline or corporate governance is not there or absent in the number of these businesses where those promoters or sponsors would, rather spend things on lifestyle rather than take care of the investors. And we're replete with stories around that in the society and in the business space as well. This slide speaks to lower your business risk, the higher the ability to absorb financial risk. So basically, what I said earlier around in the last slide around don't take if you have fixed costs, that's really what this is saying. It's the same thing. Your business risk is the the presence of or the relationship between your sales, your fixed cost, and your variable cost. That's your business risk. So your ability to cover your fixed cost and variable cost is your business risk. So if you have a high amount of a higher risk job, meaning that you're not able to cover that easily, you don't need to go and take debt to add to the problem. It's almost like doing the same thing and expecting a different outcome. As much as possible, to the extent that you can, both very important. They play specific roles, but they all both complement to enhance the value of your company at that time. Although I know that is the subject to your ability to attract both. But if you can, why not? Don't say you want to use your equity alone. Debt particularly has a role to play in enhancing the value of the company, because after you've paid your debt holder, whatever is the residual income or value left belongs entirely to your equity holders, and you have used debt to expand that value, and you paid it back, and then the rest is just what you and your other shareholders would enjoy or share as capital that is being repatriated back to you. Next slide. I think that is the last slide. Sorry that it took a while. I just wanted to. I hope I've not. I believe I've not overrun too much, but it's fine.
Thank you so much, Kunle. I think this has been very, very insightful. If you're on my system right now, you see that I have like 2 or 3 pages of notes that I've taken down, because there's a lot of information, very valuable information that personally, I found very, very useful, and I intend to utilize moving forward. So thank you very much. And this has been very, very informative. I'm sure that there are lots of questions. Maybe before going to the questions, let me just highlight some of the things that I personally have gathered. And I think that can help even the audience to maybe begin to streamline some of the contents that you have shared. You started basically talking about the risk and reward of external funding. And I like the analogy that you gave, that even Dangote, they find money. And the moment you said that, Burna Boy just played in my head, so that's everybody. At some point you need money, and you have to look at different sources, starting from either bootstrapping, which of course involves your own personal funding, but also looking at other angel investors, venture capitalists, business loans, and the microfinance banks, grants, also incubators and accelerators, but also considering the business cycle that you are in to look at the kind of funding that you can get, whether you're in startup, traction, growth, or maturity stage. That determines what kind of investment you're looking out for, what kind of funding sources you should be looking out for. You also talked about some of the key fundamentals of an attractive business, which involves 6 key things: effective processes, which is bottom line down to the discipline of the business owner. You talked about a robust strategy, having that roadmap that clearly says how you will do what you're doing, when you will do it, and why you're even actually doing it. You also talked about having a strong financial health. You also talked about sound corporate governance, the people that work with you, and as well as how you manage your stakeholder relationships. Then you talked again about the processes of fundraising. Everybody needs to do their homework, go you don't just start going to get funding without actually even knowing yourself and knowing the person you're going to, or the source of the fund you're going to get the money from. Understand the market, create your business plan, build a strong team, get ready for your due diligence, because if you're asking for money, people will come and find out really if you're saying what you've said, if it's actually true. Because even for us at LSETF, if you're requesting for any of our loans or grants, we would want to know that your business exists and that your business is sustainable. You also mentioned the importance of creating a business plan, and then you talked about the considerations for debt and equity. This is looking at maybe the stage of the business, the strength of the business relationships, the proportion of fixed and variable costs, as well as the purpose of the finance. So these are some of the key things that I gathered from the session. But I'm sure that even our audience have put in a lot as well. Now, there are some few questions that the audience have asked. One of them is around, like a step-by-step, and maybe I should just read it directly. The question is, can you give a step-by-step way how a small business can grow and get external funding? Now, the key here is a small business. That's the main thing, because some of the businesses that we deal with, beneficiaries of LSETF programs, are small businesses who don't really have those big structures, those big funding to be able to do a lot of things that we have said here. And I like the fact that you mentioned that some businesses may be small and they can even outsource some of their operations. But do you want to give like a 30-second step-by-step way of how a small business can grow and get external funding?
Okay, so I guess it's really more of the things that we've discussed already in the presentation. Maybe perhaps the gentleman joined early enough or at the back of it. So in terms of steps, it's really you addressing those issues around you preparing yourself for funding, and then going through those steps that we analyzed or we discussed in the presentation. So if you refer back to the presentation, you will see some of the things we've said are useful. But basically, it's you trying to also work on the basics. I think the most important things are the basics. Putting structure around your business, organizing your business with the intent that that's what you want to do. Nobody's going to invest in things that they don't see any sense of control. They don't see any sense of governance. And they don't see any sense of strategy as well. So all of those things are important, that you are deliberate and mindful of that, and then you can follow the process around what to prepare and how to prepare, which is also in the presentation. But it's really you working on the business and making sure that the fundamentals are there.
Awesome. Thank you very much, Kunle. Again, to our audience, this session will be available on our YouTube channel. LSETF is available on YouTube, so you can always watch the video again. Kunle, there's another question here that says, what is your opinion on government loans? Is it advisable to apply for them? What is your own opinion?
In fact, I would say go for it 101%, because characteristics of those loans are, one, they are longer tenured. So I think the BOI CBN funds, I think they are 5 years or so thereabouts. Do you get me? That's one. Then two, they are cheaper. If you want to go to the market today to borrow borrow money as an SME, if you are lucky, these loans are loans that come in all include. When I say all in plus fees and everything, they call them at around 10%. I think if are below 10%, the rate at which the CBN or government has given out some of these loans are around 7.5 or so. So by the time you put everything in plus the margin of the bank, you're probably just into 10%. That's a lot of differential, and it becomes even more stark if you compare to microfinance loans that are way more expensive. So the fact that it's longer for you and gives you time for you to use it to get the results into your business, and then it's cheaper and gives you a bit more room to recover the cost, I think it's better, as it were. And it's the same set of banks that will give you the conventional loans that will still help you appraise this and help you apply for it as well. So why not if not?
Great. So of course it's cheaper, you have longer terms and even less stricter conditions. So that you have your answer. We have another question here from Hamid Owolabi says, what is the correlation between your revenue and the amount of loan you can obtain? This is speaking to debt.
Okay. So the answer is there is a positive and strong correlation, because your revenue your revenue is going to generate what you call the cash flow. So the cash you generate from those revenues are what you are going to use to pay your debts. Do you get me? So basically, I don't want to give you net or financial speak, but basically, just the common sense is that if you're able to generate X amount of revenue, out of that revenue, you will turn X amount of it as cash. When you take a loan, that cash will be used to pay the interest and the principal back. Depending on the robustness of that revenue, it will determine one, how much you can take, because again, that cash flow will be able to cover those loans, and then how long it takes you to repay too as well, because again, the frequency of you collecting that cash will determine how quickly you can pay back the loan as well. So it's correlated. The bank will do their credit analysis based on your revenue, working down to your cash flows. You hear me? So it's very important.
Okay, maybe to expand a bit on that question, I think it's more or less, so as an individual, if you're taking a personal loan from the bank, I know the bank will check your income and say maybe you're not allowed to take more than 30 or 33% of your income as loan, right? And so in those specific figures and ratios, how then will a business owner looking at the revenue be able to say what's the amount I can actually, or what's a percentage of revenue or percentage of profit that I can actually take as a loan?
So there's no hard and fast rule in terms of amount or percentage that you need to take. The numbers will make it obvious to you. But the key thing is such that you make revenue. Do you get me? Revenue is not yet profit. Don't forget. You make revenue, you take out your costs, and that's why I was talking about fixed cost and variable cost. You take both of them out. Whatever is left is now what you are able to use to pay debt. Do you get me? Which is what you call your EBITDA. In accounting speak, it's called earnings before interest, depreciation, and amortization. That's your EBITDA. So the size of your EBITDA will be able to tell you how much debt you can take. So again, it's two legs. The one leg you have arrived at your EBITDA. Do you get me? The other leg is if you're to take X amount, how much will be the interest and principal payment? Do you get me? And how much of that can you recover from your EBITDA? By the time you place that against your EBITDA, it must still be positive. If it's negative, then you can't take beyond your EBITDA. Do you get me? So that's basically like your EBITDA determines the maximum capacity of debt you can take, more or less.
Okay, awesome. Thank you very much, Kule. The question from Uche Jumbo says, why are angel investors hard to find, both online and offline?
So they are hard to find, to be honest, because again, I mean, the direction of the economy and all of those things, the size of people that will qualify as angel investor today would definitely be impacted by what's going on economically. But more importantly, angel investor is not necessarily, how will I put it now, somebody formal or far away from you. The most important thing is for you to understand who that person is. It could be anybody. So for instance, in my own case, I've seen my tailor send me a message saying he wants to discuss a proposal with me around his business. And if I was able to invest, he will pay back X and Y and Z. Do you get me? If I go ahead with that investment, in that case, I'm an angel investor, more or less. Do you get me? So angel investor can be anybody around you, definitely within your network. Like first of all, do you get me? And then if you go as you go further out of your network, it becomes a bit more formal. Do you get me? Will be anybody around you that has the resources to fund your business, and you've had a conversation around rewards, returns. Do you get me? And they're able to provide it as it were. If I were going to go out looking for an angel investor today, what I'll probably do, I will start with people I know. Do you get me? The HNIs in my space. Try and get a sense of what is their what. Do you get me? what interests them from an investment point of view, what are they invested in, do you get me? And then if I feel that there's a link or an alignment in terms of what they are doing, and then make an approach. But it's anybody, it's not necessarily one particular person that sets up shop to say, I'm just investing, do you get me? It's really people just investing the excess cash they have beyond the non-traditional, beyond the traditional means of investments that are available to them.
Okay, great. So basically, one can leverage. Oh, I thought you were done speaking. Guessing.
I'm done. Thanks. I'm done.
Yeah. So I think basically one can leverage, their network, people that they know, and then start building from there. Yes.
Yes, please. Yeah, correct.
Awesome. Thank you. We have a few more questions. For a growing SME, how do you balance your taxation and payee status to stand good chance with grant or a loan?
Okay. So I think it is important that you try and be compliant to the extent that you are possible. In fact, maybe you are in a better position to answer that question than me, because I know for a fact that a state like Lagos State, do you get me, would want to. They are very particular about people paying their taxes, and if you want to give somebody grant or loan, you probably would. Part of your diligence is to look at their compliance history in that respect. Do you get me? And so is the case with, at least I know for a fact, most of the public government institutions that give these things. Do you get me? They will want to check your status, your compliance, and otherwise as well. So that's why again it's advisable to try and comply. If you get what I mean, to try and comply and pay your right taxes. Even though in a number of cases it has implication on your cash flow. But again, it's money that even if you escape now, you won't escape forever. It will always be coming under review at one point or the other. So to the extent that you can afford to pay it and declare or file the right set of taxes, because it will come into question later.
Great, thank you, Kunle. And I think maybe just to add to that, it's important if you're a business that's up to a year old, you should then start regularizing your tax records, those payee and all the other taxes, because when you want to start looking for funding, anybody, any institution will check how old the business is, and based on that, questions will be asked around your compliance to your levies and taxes. So just to add that in there. One more question from Uche. John says, is it possible to have an European business based in Europe invest in business in Nigeria, either as debt or equity? I think that would be
yes. The answer is yes, but that type of business does not sound like the one we're talking about. But yeah, the answer is yes, you can. And the reason why you can't do that is, I mean, there's free movement of capital in and out of the country by the laws of investments in the country. You're freely allowed to move in your capital, either as a business or as an individual, into Nigeria. I think the issue will be that which is a bit more complicated conversation, is if you invest FX into those businesses, then you want to be sure that you're able to take it back in FX. In that case, you have some sort of set of processes that you have to comply with, working with a bank as regulated by CBN, so that you are able to eligibly bring in the capital, and then once you want to take it out, you're able to take it out at official government rates. Do you get me?
Right.
Well, maybe that's the thing of the past now, because I heard as our new president is trying to do, is trying to liberalize the FX regime, but based on the regulation today, you have to follow some process. But other than that, if you don't even mind that you want to take the money officially, it's a question of transferring money from one bank account there to here, and it's done. So you can actually, it's not a problem.
Okay, great. So that's straight answer. You can do that. I think one more question for you is, what banks are known to support SMEs? Is this at the incubation or and gestation period? I think maybe just to expand, the question is saying, at what stage, can an SME look at what kind of banks? So if I'm at the startup stage, what kind of bank should I look to get, funding from? If I'm at the traction or growth stage, what kind of banks can I look to get funding from?
To be honest, it will either be at the earliest at the traction, maybe towards the later part of your traction stage, or more likely at your growth stage and maturity. It's easier for you to attract bank loans. Again, don't forget that I said my last slide said that banks they don't like to give money when there is no cash flow. At incubation and gestation, your cash flow capacities are limited at that point, so you won't get a lot of support. But I think more as you move further to the right of the spectrum, as in towards maturity, you will be able to get loans at that point. Yeah.
Okay, great. For some reason, we're unable to see you anymore, Kunle.
Oh, okay. Really? Sorry.
Yes, just completely dark.
Can you see me now? You try to.
Well, welcome back on screen.
Thank you. Sorry. Maybe this network and stuff.
Network and issues, yeah, understandably. I think the final question here says, what's the best strategy now to collaborate with government institutions such as LSETF? Maybe I can speak to that. For us,
you're better off now.
Let us basically know what do you even mean by collaborating with LSETF? If you want to access our loan or grant programs, there's a very clear eligibility criteria, which is available on our website. And if you follow our social media handles, you'll be able to get more details on a daily, weekly basis of how our programs work. But other than that, if you're talking about collaboration, then of course, you can reach out to our partnerships team. Of course, that's also available as well. But it will be important to know what kind of collaborations that you are talking about. So I think that answers that question. At this point, do you have any final words, Mr. Kunle?
The only thing I would just wrap up with is that the things we've discussed, it's very important for entrepreneurs, SME owners to be deliberate about what they want for their business to look like in the future and start doing those things from now. Do you get me? I live with that. Maybe I'll just stop with that Stephen Covey's comment around having the end in mind from the beginning. I think it's very, very important for businesses, even not only for funding, even for the overall success of the business. They should plan for where they want to end up at, starting from now. That's all.
Great. Thank you very much, Mr. Ibikunle Oriola. It's been very good having this session with you. Like I said, I have a very long note. I'm sure that even our participants, have taken some notes as well. To our participants, once again, this session will be available on our YouTube channel. You can check that out. And there'll be lots more series like this coming to you shortly. On the 28th of June, there'll be another webinar coming up, and then get more details about that. So follow our YouTube, follow our Instagram, Twitter, LinkedIn handles. You'll be able to get all of this information regarding our different programs. Looking forward to having you during our next session. Again, thank you very much.
Pleasure. Thank you so much. Thank you, everybody.
Awesome.